Hello, welcome to today's class. Today's very interesting session on performance measurement, performance evaluation. So we're going to start from financial and non-financial performance. Okay, starting from the mission of the company. What is a mission? Okay. Mission is a formal, short written statement which states the purpose of the company or organization, what it is actually trying to achieve. So actually, it's our mission that tells us what should be our future strategy, okay, or what should be the products and services, or what should be the method of competing in the market, or what is the purpose, whether it's a profit-seeking organization or not profit-seeking organization. Both have different missions, they have different objectives to achieve. And it is governed by policies, standards of behavior, and values and culture, just like Talent values are be inspiring, keep promises, be respectful. So so the four elements of mission statement: purpose, strategy, policies, standards of behavior. For example, if the company's policy is customer services, politeness, then you would expect that standard of behavior throughout the organization, from the staff attitude, in each and everything that value and those values and those cultures is depicted. For example, the Challenger values are be inspiring, keep promises. Then you won't miss the deadline. Managers cannot miss the deadline because these are Challenger values that they have to abide by the Challenger values. They have to be inspiring. They need to innovate. Okay, they need to bring in new products. Okay, just like they launched. New services for digital payments and digital. Now they're going to start digital reimbursements at the same time. So which is called Easy Pesa. Okay, so they keep innovating. Okay, they keep launching new and new projects because it is by their values. That comes in the mission statement. Okay, and be respectful at the same time. They can't be disrespectful to their subordinates, to the females. Okay, and I know an incident where I was working in Telenor in Pakistan in the finance and accounting department, and one of the colleague, one of the manager was fired because he was being disrespectful to his female colleague. So that's the mission for every company. For example, ACC's mission is to be a global leader in the profession by providing opportunity and open access to people of ability wherever they're in the world, supporting and promoting the highest ethical governance, professional standard, advancing the public interest. So this is the purpose of ACC, what they're for, what their customers, what they're offering, what their products and services. It's open to all. They're multinational. It's everywhere. They want to be a global leader. That's their mission. That's why they are in every country. They've got the local teams in Pakistan, in India, and everywhere they're working. They've got their education managers who are just working closely with ALPs, and they are just monitoring tutors' performance, students' performance, their results and everything. And then there's a marketing side. So it's in promoting the highest ethical governance and also advancing the public interest. So that's the mission of the company. For example, and every company has got a different mission, has got different objectives, different goals to achieve. Okay, so it is the mission statement that tells them that what they have to achieve and how they will achieve it. How they will achieve their mission. They are going to set their strategic long-term goals, and how to achieve their strategic long-term goals. They're going to set their medium-term, short-term objectives, and then the operational targets. And here it goes. How they achieve their mission statement. They don't do anything apart from the mission. So mission statement of Pepsi is provide consumers around the world. Again, it's telling you that it's a multinational, will delicious, affordable, convenient, and complementary foods and beverages. This was an education institute, okay, and a professional global body, okay. And that's selling food and consumer items. Okay, from foods and beverages to wholesome breakfast to healthy and fun daytime snacks and beverages. So it's telling the what's the purpose? Okay, delicious. Okay, have to be delicious, affordable at the same time. So you see that they're not very expensive. Okay, convenient and complementary foods and beverages. So their mission is pretty much telling us, giving us an idea what's their purpose of the business and what they're selling, what the products. And it's a very short statement. It's not very specific that how they're going to achieve it and what percentage, what are this percentage sales target or the cost targets. Nothing like that is there in the income statement. It's a very general statement telling you overall mission, purpose of the company. Such as the mission statement of Google is to organize the world's information and make it universally accessible and useful. Just like in a one-line sentence, it has just give the complete idea about what the Google products are, like Google Drive, like Google Jamboard, like Google Classroom, tons of Google products, like the Google Server, search engine, and now the Google payments are also there, Google Ads, tons of Google products that we can, Google Slides, just like Microsoft, they've got their own product like Google Slides, Google Sheets, just like the Excel sheet, and PowerPoint is Google Slides. Okay. Okay. There's a difference between the goals and objective. Goals are very long-term in general. Okay, they're strategic goals, and goals come out of the mission. Okay, your mission tells you what you have to achieve, and goals tells you this is what you have to achieve in the long term. For example, the goal can be shareholder wealth maximization. Goals are not specific. How you're going to achieve it, how you're going to achieve certain purpose set in the mission statement. So that the objectives are there. Objective is specific. Okay, tells you how to do that. Whether to by increasing the market share, or by decreasing the cost, or by decreasing the production cost, or by innovation, or by improving the quality. So objective goals doesn't tell you how to increase the shareholder wealth, how to maximize the shareholder wealth. So your objectives, which is specific, measurable, quantifiable, result bounded, and time bounded, it tells you what to achieve, what percentage, and what time. Then only a goal would become an objective. It has got this acronym. It is known as SMART. As for specific, measurable, attainable, result bounded, and time bounded as well. If I say decrease production cost by 20%, I don't tell you in what time. That's not my objective. I don't know. Okay, so I don't know unless I don't know when is the deadline for this objective, and I'll be measured on the basis of that objective. My performance would be based upon that. I won't work. I will just stop working. Imagine the hare and the tortoise, because tortoise won because he was dedicated, and he knew I'm going to win. Just take a nap. So okay, unless you're not told the time and what you have to achieve, what percentage, you won't work at all. That's the psyche. Whenever you go in an organization to work with, you're given your targets, you're given your goal sheet. Well, what is that for? Just to make you accountable for work, because this is what you have to achieve, and they're going to monitor you on daily basis, weekly basis, monthly basis. There will be a regular control meeting just to check whether the objectives have been achieved. And if they're not going to check me, I'm just gonna pose it as if I'm working on my laptop, and it may be like LBDN, look busy, do nothing. Okay. So what gets measured gets done. Okay. If nothing is going to be measured, I won't do it. Yeah. So we're cascading out of the mission are important factors which are critical for the success of an organization. Those are known as the critical success factors. So what are critical success factors? Critical success factors are the factors the company want to achieve if they want to achieve their mission, and if they want to be successful They're related to the mission and strategic long-term goals of the company. For example, there's a hospital, or there's a school. What would be the critical success factor of the school? Is to provide good education. That's it. Provide uh, good results, produce good results, and the student get and to increase the employability of the students at the same time. After passing out, they do get jobs right away in the market. That's your success. Apart from that, if you're not achieving your success, that means your mission is not being achieved. Have a look at the restaurant. What is the critical success factor of the restaurant? Why do you go to a restaurant? Because the food is very tasty, environment is very good. Just have, whenever you're thinking about the critical success factor, just think about what customer, because customer is going to provide them the business, and that and going to give them the revenue. For that, they're going to cover their cost and to earn profit. So have a look at the customer perspective. Why do you go to a certain restaurant? What do you think is a critical success factor of a restaurant? If you're waiting outside McDonald's or outside Burger King for 15 minutes and your order is not delivered, don't you think speed is also important in a restaurant? Just like quality, good quality food, such like hygienic foods, such like hygienic environment. They do ask you to visit the kitchens just to tell you, because that's a critical success factor. The kitchen would be dirty if they one day you listen that the Burger King or the McDonald's was closed because of unhygienic conditions. Would you ever go there? Or if you were eating the food and something dirty comes out of there, a lizard or something, cockroach out. Are you going to go to the same restaurant and you're going to start doing the negative marketing on social media, and you have word of mouth marketing? It's really effective. And they're going to lose their business over that critical success factor not being met. And what is the critical success factor for an airplane? Yeah, the speed at the same time. Good quality service, value for money. And whatever you're paying should have that value that you think that the services are worth it, worth the money. Yeah. And at the same time, you have the staff is talking nicely to you, and you've got nice leg space, and you're just comfortable in your flight. It's a 22-hour long flight. Yeah, going from Pakistan to maybe to Chicago. So the cleanliness, staff attitude, on-time flight. So all the cleanliness and all these factors, good food, yeah, good, yeah, drinks being served in time. So all these factors are critical success factors. And do you think critical success factor for education institute is same as the critical success factor for a restaurant? Yeah, some factors would be in common, but the missions are different, so the critical success factors varies from business to business. It's not same for every business. Okay, now we know our mission. Now we've set our long-term strategic goals, okay, which are critical success factors such as profitability, such as having good financial performance, good profitability, good liquidity, okay, competitiveness, okay, you agree, you prove you are competitive in the market, you are competing well as compared to the competitors in the market because your market share is increasing, your sales growth is increasing. That means you're being competitive. That's a critical success factor at the same time. So critical success factors are financial factors as well as non-financial factors. Some other critical factors like quality, like innovation, like flexibility. Flexibility are three things: speed of delivery, meeting customer requirements, and coping with the demand. Okay? If they tell you we're going to deliver in 3 months and then they take 4 months, that means the speed is not good. If you ask, I want product X, then they say it's not available. That means they're not meeting customer requirements. And if you ask for 10,000 units and they say only 8,000 could be met, that means they're not coping well with the demand. So they're not flexible. They're not flexible. I want evening classes. I want online classes. they're not providing me. They only say, come take physical classes. That means they're meeting my requirements. So that means they're not being flexible. So that's the critical success factor. Okay, bringing you back, mission and the strategic goals and the critical success factors. Okay, how would I know that the company is achieving those critical success factors? I need to measure them. I need to measure the performance. Those critical success factors need to be measured by certain key performance indicators that would indicate the performance of the company, and that would indicate that those critical success factors or those goals, mission have been achieved. So what are KPIs? The two things, critical success factors and KPIs. KPIs actually measures whether you're achieving your objectives or not. How would I know that I'm profitable? Profitability is a critical success factor. Then I'm going to measure it. What's the measuring unit for critical success factor? How I know that I'm achieving my objective of profitability? I'm just going to measure my gross profit margin. And then I have got a target gross profit margin. I'm going to compare whether my gross profit margin, what percentage is my gross profit with that of sales? That's the gross profit margin. What percentage is I'm earning profit is what percentage of sales? So all of these are my key performance indicators. These are key performance indicators are of two types: financial key performance indicators as well as non-financial key performance indicators. Just like your objectives could be financial and non-financial, your key performance indicators could be financial and could be non-financial. How to check the liquidity is if the objective of that critical success factors. Okay, you are clearly profitable, but you don't have enough cash to make pay for your expenses, pay for the rent, pay for the electricity bills, pay to the employees, pay for the IT services. Okay, pay for the pay for outsourcing services, subcontract your vendors. So liquidity is equally important, because profits can be manipulated, but liquidity actually tells you how much cash do you have. If you're looking to go to invest in a new project, you won't look at the profitability. You will look at the cash in hand you have, and whether you're going to and you're going to do the investment appraisal based upon cash flows, not on profitability. And you're going to take the relevant cash flows, and then if the project would be feasible, you're going to invest it. And imagine your position is not good, liquidity position is not good. You need, you want to bid for a contract, and you don't have cash in hand, and your position is not good. Okay, and you already have a debt burden on your shoulders, and the banks are not giving you bank guarantees. You won't be able to bid without a bank guarantee. So liquidity is equally important, just like other indicators. So that's a critical success factors. How to indicate the liquidity? You're going to calculate the inventory days, receivable days, and payable days, which is your working capital. Current assets minus current liabilities. What is working capital cycle? Inventory days plus receivable days minus payable days. If inventory is taking long, it's just sitting there and it's not selling. Definitely, if there are no sales, the cash is not going to come, and you're sure going to have the liquidity problems. Imagine you have sold, you're given 1 month liquidity, 1 month period to the credit period to the receivables. And that means they're not paying for 1 month. That means your capital is tied up. You've already built up your inventory. You've sold it, but your cash is not coming. How are you going to pay your payables, your suppliers, pay for the expenses, fixed expenses, rent, and all that? So you definitely need cash. So the longer the working capital cycle, the cash conversion period, that means you have liquidity problems. So the longer the inventory days, so the longer the receivables are taking to pay, that definitely you're going to have the liquidity problems. And longer the payables period, better it is, because the cash is not going out of the company. If they give you good 3 months period, that means you don't have to required to pay them for 3 months. If customers are taking 2 months and inventory takes 1.5 months, then you're good. Then you're good. Okay, you don't have to pay them until 4 months. But if it's like you have to pay in 1 month, and when inventory is taking 2 months and receivables you're getting 2 months to pay, that means you're clearly in the liquidity problems. Okay, how to measure competitiveness? Sales are not increasing. Okay, last year, from last year to this year, sales has decreased by 10%. What do you expect? Are you competitive? Just look at the customers. Maybe the customer complaints are a lot. That's why you lost your sales. And you have a look at the market share. Your market share has decreased by 100%. What does that indicate? That indicates somewhere some customer is not happy. Somewhere there's some problems. Maybe customer demands are not being met. Took the customer feedback. How to measure the flexibility? We're going to how to measure quality. KPIs are. We're going to take the customer survey feedback and complaints. We're going to know how we are performing, and also by looking at our financial figures, somewhere we will know we are lacking in non-financial performance. So your financial performance and non-financial performance are linked. Whenever you're assessing, important question in PM exam is mostly that of you have to discuss the financial and non-financial performance. You have to discuss, you have to assess the financial and non-financial performance of the company. So whenever you're discussing, first you calculate these measures, okay? And then you get to comment whether the performance was good or bad. What does that indicate? And then you go deep down and start discussing in detail. What are the reasons of good or bad performance? Why did it happen? And then same, you're going to look into the scenario, the facts and figures given in the scenario. You're going to look at it, then start discussing why certain things happened, why they were not able to achieve their objective, okay, and why their performance indicators were not good. So that's how you're going to do your performance evaluation question in the PM exam. It's tested in section C. So it's really important to create a link. If a company is lacking in the quality, how do you expect they'll be competitive and the financial performance will be good? Definitely, then they won't be able to achieve much profit, and the sales will be down. Sales will be decreasing. If they're not innovating, okay, and if they're not flexible, definitely that's going to impact the financial performance. And if question has given you that the sales are decreasing, okay, on the other hand, financial figures is given, okay, profitability is going down, okay, competitiveness is down, financial performance is down, then you would look at and you would create a link. Whether is it because of some non-financial performance, because of the bad non-financial performance? Is it because of those critical success factors, non-financial KPIs that we haven't achieved, that has affected our financial performance? So both ways you're going to link. That's the key. You're going to link, and because a question would be somewhere like this, okay? It's a 20 marks question where you have to discuss the financial and non-financial performance of Jungle Co. for the year 31st August. Okay. You need to know the action verb. It's really important. That's to discuss. Okay. And what you have to discuss, that's the object. Financial as well as non-financial performance. You have to strike the balance between financial performance indicators and non-financial performance indicators. And then of Jungle Co. That means you have to do the discussion with regard to, you have to link it to the scenario, to the facts and figures in the scenario. You don't have to create your own invented requirements. Yeah, examiners say they invent their requirements, their own requirements. They think this is right. No, you have to just talk about whatever facts were given in the question. You have to do the discussion, both balancing both financial and non-financial, and also linking to the scenario and for the given period. So you need to strike a balance between financial performance indicators and non-financial performance indicators. So coming again, start Process starts from the mission, what company want to achieve, and from that the strategic goals and critical success factors come out. And what gets measured gets done. Until you, unless you don't measure the uh, financial performance indicators and non-financial performance indicators, you don't measure their performance, you don't make a certain profit performance matrix and keep certain performance measures on that would tell you whether those strategic goals and mission and critical success factors have been achieved or not. You would never be able to assess the performance of the company. And you need to strike a balance between financial and non-financial. And for example, non-financial quality, resource, flexibility, innovation, and financial performance indicators. Most likely, you have to assess for the year ended 31st August 2016. Maybe you're given the data for the last year as well, 31st August 2015, and you have to compare. Okay, what is performance measurement all about? Performance measurement really tells you that how company is performing with regards to company's objectives, with regards to the industry, with regards to competitors, the benchmarks, with regards to standard and budget. So until and unless you don't compare your performance with that of standard, last year performance probably, with that of competitors, benchmark performance, with last year result, okay, first with the budget standard, with last year result, okay, with budget standard you get a variance. That's a very vital part of control process. That actually gives you information how well your objectives are being achieved. That is telling you about your performance. And also with that of the industry average and competitors. So until and unless you're not going to compare yourself with, for example, I have gross profit of 30%. What is that telling me? Okay, your competitor has gross profit of 35%. Oh, okay. And the industry has a gross profit of 34%. Okay, I'm lacking. So until what was your budgeted gross profit that you were required to achieve? It was 31%. So I'm clearly lacking. My performance is not good. So have a look at the other way around. Your net profit margin is 20%. Okay. What was the budgeted net profit margin? It was 25%. Okay. Okay. And what's the industry average? It's 24%. Okay. Again, you're lacking. For example, your net profit margin is 20%. What is the industry net profit margin? 14%. Competitors, 13%. Budget, 12%. Yeah, now my performance is good. So that's what you have to measure. Okay, you have to calculate certain key performance indicators, financial and analyze non-financial performance indicators. Then you have to assess how well the company has performed and how's the performance of the company. You have to discuss, first calculate the measure, then you have to make a comment. Okay, what does that indicate, whether it's good or bad? Okay, as you've figured out the performance was good, then again, you just try to link financial and non-financial performance, and then you try to get the reason. What is the reason? You start discussing what is the reason, so that unless you don't know the reason of your bad performance, you won't be able to correct yourself. Definitely you have to, when there's some meeting taking place, annual year meeting, and the result is right in front of you, the discussion, it leads to discussion. First of all, the calculation takes place, again, then report and comment, and report is right in front of you. That has got everything in it, from calculation to comment to discussion, and now you're discussing live, sitting in a meeting, and now you're going to improve your performance. You set next to your targets on the basis of that annual review meeting. Okay, so you need to know the complete picture right in front of you. Okay, so what gets measured gets done. Okay, if I know I won't be measured against any of the criteria, whether we have the innovation, bringing new products, target was 4. Okay, I haven't introduced any new product in the market. Maybe innovation in Burger King would be to get a new burger, a new kind of burger with a different taste. That's innovation. And if I'm not meeting flexibility or customer orders are delayed, okay, there will be some non-financial performance there as well that would indicate how well you've performed. And then the customer complaints from 2015 to 2016, customer complaints have increased by 15%. Last year it was 1,000 and now it's probably 1,200. So definitely you're lacking somewhere, and that's going to affect your financial performance at the same time. So most likely for financial analysis, okay, most likely you're given an income statement for 2 years or any benchmark competitors data or any industry average that you have to compare with. And same can be for non-financial performance indicators. You're giving the competitor data or industry average, it's most likely. Or mostly you're just given the internal information from last year. Okay, so whatever is there in the data provided, the data sections, whatever information is there in the form of tables or in the form of data section or probably in the form of income statement, you have to do the financial analysis as well as the non-financial analysis. So financial analysis is basically ratio analysis. So you have to calculate the profitability ratios. That's one. That's telling you that the company is profitable or not. Then the liquidity ratios, they're going to tell you that whether you have any of the liquidity problems. And then the risk analysis, that's going to tell you whether you have any solvency issues. Company may get insolvent if it has got a lot of debt burden. Out of the 2 lakh capital employed, 1 lakh is, maybe 150 out of 2 lakh. It's the debt the company is taking. So if they're going to default on the interest payments and on the capital payments, then it's more likely the company not going to be going concern. So they have to meet the interest payments and all that by producing good profits. And if they don't have good profits, okay, they don't have profit before interest and tax, this is operating profit, as much as to pay off their interest payments. Definitely there is this risk factor the company is not going to be solving. So these are the risk related ratios. That's how you have to assess the overall performance. Now moving back to the ratios, that's what we have to calculate. Return on capital employed, we did in the last session as well. Controllable profit or controllable capital employed, and profit before interest and tax or capital employed. I told you the 2 formulas for capital employed, one net assets and one debt plus non-current liabilities, and both sides are equal. So in whatever form the data is being provided, you have to calculate the figures for capital employed accordingly. And then asset turnover. Okay, asset turnover tells you sales is what percentage of what times of your capital employed. If capital employed is for example 1 lakh and you're generating sales of 2 lakh, that means the sales is 2 times of capital employed. It goes like this. If 3 lakh, 3 times, 4 lakh, so that's how it goes. So the more times it is, more profitable the company would ultimately be. More the return on capital employed, more profitable the company will be. And the ROCE is basically a product of asset turnover and operating profit margin. I told you in my previous. And operating profit margin tells you what percentage is your operating profit as a percentage of sales. Gross profit, what percentage is gross profit as a percentage of sales. Net profit, what percentage is net profit as a percentage of your sales. If I take it to this question here, sales revenue is 1 lakh, production cost is 50,000, gross profit is 50,000. So that means what is a gross profit margin? So here I can calculate my gross profit margin as gross profit divided by sales into 100, and it's going to be 50,000 divided by 1 lakh. It's going to be 50%. What is that telling you? That's telling me out of 100% of sales revenue, 50% is gross profit. That means 50% is my production cost. if you calculate your production cost to sales ratio, that's going to give you the same figure. 50,000 production cost, 1 lakh revenue, it's going to be 50%. Gross profit 50,000 divided by sales revenue 1 lakh. It's going to tell you it's 50%. So that's what I've told you here. And how comes the operating profit? If you deduct non-production cost, you may have your selling, admin, distribution, okay? So you deduct that cost as well. You'll get PBIT, profit before interest and tax. That's 40,000. What does that tell me? And what is my operating profit margin if I get to calculate? Operating profit margin is operating profit divided by sales. It's going to be 40%. What is that telling me? That's telling me if the operating profit is 40%, okay, so what else needs to be deducted? It's 10% more cost that brings the profit down, gross profit down from 50 to 40. What is that cost? That is my non-production cost. Is it 10% of sales revenue? Yes, 10,000 divided by 1 lakh is 10%. So if your sales revenue is 1 lakh and your operating profit, the sales revenue is 1 lakh and your operating profit is 40,000, what does that suggest? That means your 60% is your total cost. And total cost includes production cost as well as non-production cost. And out of 60%, 50% is my production cost. What is now my non-production cost? 10% was my non-production. So easy. And if interest and tax are also deducted, then you get the net profit. And what is net profit margin? If 15% more cost is deducted from here, what you would get, that's your net profit, 25%. Okay, and that's basically net profit is basically profit available to shareholders. And then you may announce dividends, 5,000 is dividends. Then this very remaining thing goes to your retained profit, becomes a part of the equity. So, and from here, you are given the capital employed. Capital employed is 2 lakh. Okay, and you're also given some data, like here, like net assets data, to 10,000, land and building plus current assets, 50,000 minus 60,000. That actually makes 2 lakh. And you can also calculate now your ROS, which is product of operating profit margin, as well as your asset turnover. You can also check your operating profit is 40%. And what is your asset turnover? Sales divided by capital employed. Sales over capital employed. Sales is 1 lakh and your capital employed is 2 lakh. That means your sales is basically half of the capital employed, 0.5 times. The more the sales are, okay, that means more the times the sales is as a percentage of capital employed. So definitely your return on capital employed would improve. How to calculate? You can also calculate 40 into 0.5, you would get your return on capital employed as. So that means your return on capital employed is 20%. And that you can also calculate like 40,000 profit before interest and tax divided by capital employed of 2 lakh. Operating profit divided by capital employed. You can calculate your ROC, which also turns out to be 20%. And then there's one thing more that I can calculate from these figures, which is interest cover. What does interest cover tell me? And I can also calculate another solvency ratio, which is dividend cover. let me take you to the profitability. We're done with the profitability ratios. Now moving over to the risk-related ratios, which are the solvency ratios. It just tells you how much is the debt burden of the, how much is debt of debt percentage of equity, what percentage is debt over, how much is debt as a percentage of total capital employed. It just tells you whether the company has high risk. If debt burden is high, then definitely there's a chances of company not being able to make the debt pay, not being able to make the payments, and also so that's the they might get might not be the going concern, might be put into liquidation by the bank or something like that. And there's something as interest cover, and also there's dividend cover. Okay, how do you calculate the interest covers? How many times you can pay your finance cost, your interest cost out of the profit before interest and tax? Why I would take profit before interest and tax? Because after operating profit, interest is amount is deducted. If you go back and check here, so what is the if I utilize the space here, we will calculate interest cover. Interest cover, first I'm going to calculate. It's profit before interest and tax divided by finance cost or the interest cost. What is the interest cost? What is profit before interest and tax? It was 40,000. Okay. And what is the interest cost? 10,000. 4 times you can pay this amount from your profit. That means you don't have any risk. 4 times, 5 times, 10 times, that you have enough profits to meet your liabilities. Then that means you're not in a risk. You can easily pay your interest in time, and there are no chances of liquidation. But if it would be, if it had been like 8,000, then you're clearly in a problem. The profit is 8,000, and you have to be, you're not able to meet it once. You're clearly in problems. You're clearly, there's a risk that you will go into liquidation. So the more the figure is, the better your performance is. And same with dividend cover. How are dividends calculated? Dividend are given from your net profit. Here I would formalize net profit divided by dividend amount. And same it tells you how much times you can pay your dividend out of your net profit. Why would I take net profit, and here why I did take operating profit? Because interest is deducted from this amount. So I have to take how much interest can be paid from out of this 40,000. And same, how much times my dividend can be paid out of that 25,000. So it's going to be 25,000 divided by 5,000. 5 times I can pay my dividends. So I'm not in problems. My shareholder would be happy. That means I have enough profit. So the performance of the company looks good. But yet again, you have to compare. These are just alone figures that we calculated, doing the calculation part. When it's discussion and when you're doing the analysis, you need to have comparative data with maybe budget, or maybe competitive data, maybe industry average, or maybe some other non-financial factors that would tell you your clear performance picture. Maybe we are good in financial performance, but maybe customers are not happy. There are a lot of customer complaints, and we're not flexible, we're not able to cope with the demand, meet their requirements. So definitely, I will start losing my market share. Not now, but in the long term, I will start losing my sales, market share. I'm not. Yeah, so those factors are equally important at the same time. So these are. And if I calculate my financial gearing, the formula, there are 2 formulas for financial gearing. That's also a risk ratio. Profitability ratio, liquidity ratio, and then risk ratio. And the risk ratio for liquidity ratios. Okay, financial gearing. Debt. What is debt? Debt is, financial gearing is two formulas. Debt over equity into 100. And the other formula is debt is over capital employed. And capital employed is debt plus equity. So, what is the percentage of debt? As a percentage of equity and as a percentage of capital employed. That would tell me whether the company has a high debt burden or not. Clearly has got high debt burden because debt is what percentage of equity is 50,000 only. So 150 by 50, that makes that 300% it is. And what is debt over capital employed? So debt is 150,000 and capital employed is 2 lakh. 150,000 divided by 2 lakh into 100. 75% out of 100%, that means out of 100% of capital employed, 75% is debt. So the rest of 25% is going to be your equity, which is going to be 50,000 divided by 2 lakh. So out of capital employed is 100%. So 75% as a percentage of 100 capital employed is debt, and only 25% is the equity. So definitely companies really highly geared. But the performance, but the profit is enough to meet the liabilities. As far as the sales are good and profits are good, they'll be able to meet their liabilities. But definitely company is highly geared, relying too much on the debt than on the capital. So they really have to maintain the competitiveness and really have to maintain the level of sales, else they won't be able to meet their liability. So now there's one more ratio, which is called the operational gearing. So, it basically tells you the total fixed cost burden on the organization. If your fixed cost is a lot of percentage of total cost, then definitely you have high operational gearing. It measures the financial gearing. It measures the operational gearing. Why? Because you have to cover your fixed cost out of your operational profits. Definitely, from your sales, you have to cover your fixed cost, your monthly fixed cost, or your yearly fixed cost. Okay, I'm doing my online business. Why I want to open a physical school, or why I want to open a physical shop? Because I doubt that my sales are not that much that I would be able to cover my fixed cost. So, and I don't want to take that burden. So if a company already has a lot of fixed cost, they took the fixed cost in the past, they have the fixed cost, high percentage of the total cost. That means they've got high burden, high fixed cost burden. And what in a month, they don't have customers, they don't have orders, they won't have sales, but they still have to cover the fixed cost. How are they going to cover it? So that comes the problem. Clearly, in this corona pandemic, though the businesses were closed, but still they had to pay their liabilities. They had to pay their fixed cost salaries to their employees, though they just reduced it to 50%, and mostly, and some really laid off their employees. But still, they have rental costs, they have other obligations that they cannot cope with. And some really increased their fixed cost. Some were not digital, okay, were not, and then they started digitalizing, and then they maybe took more of the fixed cost. For example, schools who didn't have their online systems, they started investing. They started with Microsoft Teams. Some started with Google Classroom. Okay, so that would have increased their member subscription. They need to pay in order to become the subscriber. In order to become the member, they need to pay their fixed cost. So fixed cost is really hard to cover from the sales because you have to cover that cost from your operating profit. So let's just okay, here the cost breakup is not on fixed in total. Let me explain to you. For example, your fixed cost is 50,000 and your total cost is 80,000. You clearly have high operational gearing. 50. (62.5% of your total cost. Here total cost is 100%. That tells me 62.5% of your total cost is your fixed cost. High operation gearing. That means the remaining cost, okay, the remainder cost would be the variable. Variable cost you can easily cover from your sales. And you also have to cover your fixed cost from the sales as well. Otherwise you won't be in the break even. And in order to be the profit, you need to generate contribution more than the fixed cost. Then only you will be at profit. So if you're not covering your fixed cost, that means clearly you are at risk. You have high fixed cost burden on you. And now there are liquidity ratios. It really tells you that whether you're liquid, whether you have cash in hand or not, whether you don't have liquidity problems, you don't have cash problems, and you have good working capital cycle that you're just doing financing yourself from the working capital and you're not taking any of the overdraft. What you're doing is that whatever is coming from the customer, you take that amount and pay to the suppliers and pay your expenses. That means that's good working capital management. But if your working capital management is not good, that means you're clearly in the liquidity problem. So current ratio is also known as the what is the current ratio? Asset ratio, also known as asset ratio. The formula is current assets over current liabilities. What does that tell you? The ideal is 2:1. That means you need to have the current assets twice of the current liabilities. You need to have that means for every $2 of current, $1 of liabilities, you need to have $2 of current assets. Then only this ideal 2:1 would be met. And what is asset test ratio? Also known as quick ratio. It considers that in current asset there's an item, inventory, which is least liquid item. Okay, so if you deduct that and then you take how many times are your current assets net of stock of that of liabilities, and then check whether you are in good liquidity position or not. Here the ideal is 1:1. That means for every $1 of current assets less stock, you should have $1. For every $1 of liability, you should have $1 of current assets minus stock. Okay, so if you have 1 lakh liability and you have 1 lakh for that, then that means you have the ideal asset test ratio for that. And that means if you have 2 lakh of liability, 2 lakh of assets for 1 lakh of liabilities, then that means you're clearly meeting, you're not in liquidity problems. But imagine if you have 2 lakh of liabilities and you only have 1 lakh of assets, the other way around. No, you don't have twice assets to meet your current liabilities. Definitely, you may be in problems, cash problems. And here, at the same time, you only have 80,000 of your net of current asset net of stock, and your current liabilities are 1 lakh. That makes 0.8:1. However, the ideal was 1:1. So you're clearly in the liquidity problems. If you're taking long to sell the inventory, then that means you're in liquidity problems at the same time. If the credit period is long, how is that measured? Inventory days. Inventory, okay, divided by you're given the item from the balance sheet. You're also given financial statement. At times you're given balance sheet. Mostly you're given financial statement. So these ratios won't be tested. More likely, you would be required to measure these ratios and also ROS. Okay, most likely. But balance sheet could come, so really you'll be required to measure the solvency ratios as well as liquidity ratios. So, so how to calculate inventory days? Inventory divided by cost of goods sold. You'll be given cost of sales. Okay. And into 365 days. This would tell you out of 365 days, how much time is inventory taking, okay, to be sold. So same for receivables, account receivables, you will be given from current assets and divided by credit sales. Only you take credit sales. That comes, your receivables comes from. You won't take cash sales here. So how many times the receivables are taken? Same for account payables, divided by either cost of goods sold or credit purchase, whichever is given there in the scenario. You take that. And at times, if you also use credit purchases here, if you're not given the cost of goods sold, it's better to take cost of goods sold if in case of inventory. So what I was telling you about asset test ratio, current ratio. Okay, so the ideal is 2:1. It says for every $2. For every $1 of current liability should have $2 of current assets. That's the idea. So if you have current, and the formula is current assets over current liability. So if you have 1 lakh of current liability and 2 lakh of assets, that means this becomes 0, and the ideal is 2:1. You have the figure of 2:1. If this ratio is 2, then that means you're meeting the ideal standard. And same goes for quick ratio, which is asset test ratio. Ideal is 1:1. And how is it calculated? Current assets minus stock divided by current liability. Ideal is 1:1. So if, for example, 1 lakh for your current assets, okay, and 20,000 was your stock, and your current liability is 1 lakh, okay, that becomes 80,000. That means you have 80,000. 0.8 for every $1. You need to have, for every $1, you need to have $1 of current liability, current assets to back $1 current liabilities. But here, you 80,000 divided by 1 lakh, that means 0.8:1 is the ratio. However, ideal, you're not meeting ideal. Here you are in liquidity problem. So that's why we minus stock, because we consider stock as the least liquid asset. If you have stock, you don't know if it's going to sell, maybe it will get stolen, maybe it will get damaged, maybe it will get out of fashion, it will get obsolete. Okay, so there's the risk in the inventory. If inventory is there, there's a risk. That's why throughput consider that we don't hold inventory unless you have an order, just to be safe and to bear no additional holding cost and ordering cost and all that, and just to reduce the inventory cost. That increases your throughput. So now how to calculate the current ratio and acid test ratio in my example that I did here, there. Okay. Let's just delete this. We are given our total assets, land buildings of 2,10,000, and we have current assets of 50,000 and current liabilities of 60,000. Okay, we can calculate our both of these ratios. Current ratio is going to be current assets is 50,000 and current liabilities is 60,000. It has to be 2:1, but here it's not. So it gives 0.83 clearly in the liquidity cover. See, the profit is good, gearing is less, interest cover, dividend cover are good, but here they have liquidity cover. Current, okay, not much, but yes, it is there. And if current ratio is not somewhat near to the ideal, the quick ratio, when we are going to deduct the stock as well from 50,000, and what is the stock amount? Here is this note here. It includes inventory of 10,000. If we're going to deduct this, it's going to deteriorate even further. The current liabilities are the same. Here you only have 40,000 to pay 60,000. Ideally, you should have 60,000 to pay 60,000 of liabilities. So here again, it's not ideal. Ideal here is 1:1, and here it is 40,000 divided by 60,000. So here it is 0.66:1. Okay. So that's how you're going to analyze. And now moving on to how you're going to, this is a performance evaluation strategy that you're going to apply in every question, in every scenario. So here, if I go back to the question here, it was a 20-mark requirement. It was a 20-mark requirement, and 14 marks were available for discussion, and only rest of the marks were available for the calculation. So here, more marks are available for the discussion. Okay, more marks are available, less marks for calculation, more marks for discussion. There are two things in the discussion. First, you have to make a comment, and then you have to discuss that why that thing happened. What is the reason of good and bad performance? By linking to the scenario and as well as linking financial perspective as well as the non-financial perspective in doing your analysis. There are a couple of things that you need to understand while handling a performance evaluation question. Understand time management. In a 20-mark question, 36 marks requirement, as per 1.5 minute per 1 mark rule, keep 6 minutes for reading and planning time, and the rest of 30 minutes you need to allocate like 20 minutes for discussion and 8 to 10 minutes for calculation approximately. 2/3 of your total time should be for discussion, and the 1/3 of the time should be for calculation. Okay, not more than 8. If 8, keeping this 22. If 10, that's 20. Not more than that. Okay, and you need to understand the requirements, especially the work, what you have to discuss or it's evaluate, assess, what's the requirement. If it's like that, so next is read the requirement. And then once you have understood the time management, here the question right in front of you. Now you have to utilize effectively that 6 minutes. How are you going to do that? And then you read the requirement. Okay, first read the requirement, and then you plan and structure your answer, decide the layout, okay, how you're going to do that. And then you start reading the exhibits and start extracting the key information from the scenario. Okay, critical is the price information. Price could make your revenues, profit go worse. It's really important. Any important changes, any important decisions took place in the last, at the start of the year may impact your performance, either in the good way or in the bad way. So just keep note of the important changes. Any percentage figures given in the question, okay, they are there, the key information. There might be some key information attached to it, so just don't ignore any percentage figures, relative figures given in the scenario. or any external information such as economic conditions may be bad. So you just do relate when you're talking about the decrease in sale, do relate. These are because of the bad economic conditions. And some competitors' information you would be there that would help you to discuss the performance, how they've performed well, do the analysis, and then discuss how whether they've performed well with respect to competitors as well or not. And then you need to know what is type of the business, whether it's a technological business, what is the kind of the business, whether it's education. Then definitely the mission is different, critical success factors would be different. So the key performance indicators, financial, non-financial, would be different. Okay. So what performance measures to calculate for performance evaluation? You can get an idea from the exhibits, such as maybe a table is given, or maybe income statement or extract or balance sheet extract is given. So you need to know, you may have a clear idea, may have a rough idea of what profitability ratio, maybe liquidity ratios, maybe solvency ratios we have to calculate. But don't over calculate things. You have more marks for discussion, not for calculation. And no need to overdo calculation, recheck calculation again. Remember own figure rule, okay? If you did one working wrong and that is being used elsewhere as well, and you did the discussion right, you would get the marks for that. So no need to go over the calculations and recheck calculations and overdo calculations. Like 8 is fine as per the marks available. Okay, 8, and you will get an idea from the extract what you have to calculate. If it's income statement, maybe you will calculate the increase in sale, maybe you will calculate increase in operating profit, increase in net profit, maybe operating profit margin, you would calculate, maybe ROC you would calculate. So you will get an idea what you have to calculate from the data sections available. Either the income statement or some table is given for non-financial indicators, for example. And you have to strike the balance between, because the question tells you assess financial and non-financial performance. Non-financial cannot be discussed without financial, and financial cannot be discussed without. So you have to create the link between the two at the same time. Okay, when time is done for calculation and you need to move on to your discussion, even if you feel you haven't done enough, most of the marks will come from your analysis, not your calculation. So don't overdo calculation. What to calculate? Your goal is to evaluate from a broad perspective, okay? Financial, non-financial. So this means you need to strike a balance between financial and non-financial. And for example, there's a wide range of data is available. Okay, maybe a lot of section, maybe a lot of rows and columns, and okay. So just take the selective data out. Okay, selective ratios. Calculate relevant ratios from each section, but don't overdo. It will not give you marks. Discussion time is 20. Now tips for discussion. Discussion time is 20 at least. Use simple strategy. Calculate, comment, discuss. That will go over again. Calculate. Okay. For example, if increase in sales revenue is 15%, okay, sales growth that we have calculated. We did the calculation. Okay, we say it's a good sign and it's because of this and this. Okay, that's our comment. But we haven't discussed why this happened. Now it's time to go back, and what you did in the reading and planning stage, maybe there's a scratch pad available over there, just write it down over there. But there's a highlighter available in the section C. You can highlight while reading the scenario at the same time. So maybe you got that key information. Now in the discussion stage, you have to relate to that key information as why that thing has happened. And while discussing, use headings and subheadings. Use short paragraphs. It should be heading of the short paragraph. And heading of the short paragraph comes from the calculation. What the calculation was. Increase in gross profit margin, increase in sales, that would be a heading. And then would come comment, and then would maybe one paragraph for comment and another paragraph for discussion. But in discussion, you will do talk about, comment discussion also, you will do talk about financial as well as non-financial, linking both with that particular calculation you did, that particular performance measure. For general statements, without linking to scenario, without paragraph, without using the strategy, you won't get marks. 2 by 3. You won't get 14, 15 marks out of 20 is off. for discussion. You won't get marks for that. Maybe you're just getting out of 20, you're just getting, maybe your calculations are wrong, you're just getting 3 to 4 marks. So imagine how crucial, how critical it is to understand how to handle a performance evaluation. Once you know these steps and techniques in examination techniques, it's very easy, it becomes very easy. And also in discussion, use relative terms for information already given in percentages. For example, there's given that percentage occupancy increased from 72 in 1 year to 74. Okay, if I say increase of 2%, that basically, if I just talk that, keep that absolute, and I don't uh, calculate the percentage increase. The percentage increase would be the base figure, new figure minus base figure, old figure, divided by base figure into 100. And the increase is 2.78%. If you're talking that percentage occupancy in here was 72% and it now decreased to 74%, it's not giving you any idea unless you comprehend it and use relative terms like increase of 2.78% in the form of percent. Here I didn't add percent, to add percent. Avoid the common mistake of producing and writing about absolute changes. For example, customer complaints are 1,000 and now they are 5,000. Just calculate what is the increase. 4,000 minus 1,000 divided by 1,000. It would give you the increase in the customer complaints in the form of percentages. Don't use relative percentage. Clearly, this is the statement I took from the technical article. Only relative changes in percentage will be awarded marks. Rest won't be awarded. Even if you're doing discussion right, you know what is, your comment was right, your analysis is right, but you're not using in the form of percentages, relative figures you're not using, you won't get marks. Link both financial and non-financial is a core aspect of performance management syllabus everywhere, and also critical to performance evaluation question. It's critical that you show and contrast both perspectives in your answer. For example, if there are 8 measures that you're discussing using the same strategy, calculate, comment, discuss for 1, calculate, comment, discuss for 2. So there'll be 8 headings, 8 measures, 8 headings. 8 headings and maybe 2 paragraphs each. Okay, calculate, comment would come in one, and discussion you would. And in discussion, you would relate both financial and non-financial. And in discussion, you would go back to the scenario and link your answer to the key information given in the scenario. For example, these are the indicators, profit loss. These are the sections from which you selected the indicators. Here, change in revenue, change in gross profit, change in net profit, change in revenue by product line will give you more information. Change in customer services cost, change in admin cost. Okay, go horizontally, horizontal as well as vertical. Operating profit to sales is vertical. But sales in 1 year and sales in the other year, and you want to increase the sale, it's going to be a horizontal calculation, horizontal measure, vertical measure, horizontal measure. And now going back to this key strategy, calculate any changes in the performance measure. Sales, for example, key success factors, profitability, and the measure was increase in sales revenue or increase in profit. This is the heading to your paragraph. This is going to be the heading to your paragraph. And comment what your number indicate, whether it's good or bad. But just this is not enough to give you marks. Okay? Just making a comment won't give you marks. Students think that they have done the question. They would get good marks. I missed this important part. Here discussion why the performance was bad, good or bad. Imagine that annual meeting in which we need to correct ourselves and we need to set targets for the next year. Here we need to know what went wrong. So here, if you would not analyze your performance as good or bad and the factors that have caused, the reason that have caused, properly linking to the scenario and keeping a balance between financial and non-financial, you actually in discussion, you need to bring multiple pieces of information together to assess, discuss your performance. That's the discussion. Simple strategy. Calculate, comment, discuss. Here, calculate, comment, discuss. For example, 15% is the increase in revenue. That's the heading. This comes directly from the working, which gives your paragraph a heading. That's the calculate. 15% increase in revenue was there. 20% decrease in operating profit. That's your heading. This is a good sign. Decrease in operating profit, this is a bad sign. It shows that a little comment you're making. Comment, just give it a little, so make some few points there as well in the comment section. It shows that Jungle is selling more units because prices are stable and or the new cloud service is expanding, but we need a breakdown of revenue to fully understand this. See, maybe you analyze the breakdown of the revenue. Maybe when you analyze it, okay, maybe it will give you a different scenario about the performance. Different, maybe there may be some more problems. The more points that you have to link with the scenario, and also that would give you financial assessment as well as non-financial. Here is where you gain marks by developing your point with links to the scenario and talking about why the change has happened. Okay, why? What has caused the reason? You have to discuss of the 3 lines. You have to discuss for each and every line there in your discussion. Otherwise, you won't get marks for that. These are my key exam success points, especially for performance evaluation question. That read the requirement, know what you have to do, extract key information related to the scenario. Simple strategy to follow. Calculate, comment, and discuss. Question would be like this that I showed you earlier. This. What gets measured gets done. You're not going to measure, mission goals won't be achieved. That's pretty good. Ratio analysis, key factors you have to pick, and then you have to calculate, comment what they indicate, and then discuss at the same time. And also keeping a balance and linking it to this part in the discussion phase, linking it to this part. Okay. Thank you very much.